We'll talk about the economy, we'll talk about finance, we'll talk about the financial crisis of 2008, and we'll talk about the coronavirus. Let's see if I can get you to see what I see. It's coming up. Okay, everyone. So here we have a diagram by the Federal Reserve. This is a chart showing the federal debt, sometimes known as the national debt. And you can see that from 1970, it goes from very few billions of dollars to more than 24 trillion dollars. To be fair, it's around 23 trillion 600 billion right now. That is the national debt. So as I'm saying, this is somehow deceptive. The question is how. In other words, we all know that the government spends a lot of money, and over time it spends more and more money. And here we have it just kind of going diagonally. And then we can see this seems a little bit steep, so maybe that's a little concerning. But now let me explain to you why this is deceptive. Consider the US debt clock. So here we go. Here's the 23 trillion that I mentioned a moment ago, 23 trillion 617 billion. And you can see how faster than 1 second the US goes through, say, $10,000, $20,000. Faster than 1 second, we're going through that. The question is, how did that happen? And can it be stopped? Is there any point in stopping it? I mean, why not? Let it just go up indefinitely. This sort of public service website keeps track of all kinds of things, from the national debt to how much of that do you owe if we divide it per citizen. Each of us owes around $71,000. But some of you are not taxpayers. So if we don't count what you owe, then it's only $190,000 to those of us like me who actually do pay taxes. The rest of you can just enjoy living free of taxes. But so the question is, how did it get to be that big? And to illustrate that, I came up with this chart. So if we start around 1930, 1940, again, the debt was relatively low at multiple billions of dollars. But we add up 36 presidents in the history of the United States. The debt that was accumulated for the entire country by those presidents. This purple section represents 36 presidents right before Richard Nixon. And so jointly several hundreds of billions of dollars. Nixon contributes this slice of debt, that bright red one, followed by Ford, eventually followed by, this is Ronald Reagan, this red square, followed by George Herbert Walker Bush, followed by Clinton, then we get to Bush and Obama. The difference that I want to show you first is how this particular diagram, which I had to construct myself, and what seems to be this exponential growth of the debt, meaning we were in this relatively smooth, nearly horizontal slope for decades. And then after Nixon takes us off the gold standard in the early 1970s, we start seeing this expansion of the public debt. It reaches these enormous proportions under Reagan, Bush, and Clinton, and then it again has these massive, extraordinary growths. Politically, the Democrats are allegedly known for taxing and spending, while the Republicans pretend that that they care about the national debt, and that they don't want to spend as much as the Democrats. However, when you look at this difference, how much Bill Clinton had indebted the country in 8 years, and then you compare that with how much George Bush indebted the country, you see that the truth was that the Republicans were not fiscally conservative. This is a complete fiction. This has nothing to do with reality. In fact, what George W. Bush did was he nearly doubled all the debt that had been created by all previous presidents before him. That is 36, 37, 38, 39, 40, 41, 42 presidents until 43 comes along. And here I'm comparing what W. Bush did compared to what all the others did. When Barack Obama ran for president, of course, he found this to be horrifying, disturbing, and alarming. And he ran criticizing the fact that Bush had nearly doubled the national debt in just 8 years. Obama came along, and what happened? Again, if we compare this to what Obama did, we find that Obama did the same thing, or in other words, he did something worse, which is he almost doubled the debt that Bush alone had created in a period of 8 years. And then when we compare the debt that was created under Obama, we see again that it is nearly all the debt that had been created by all previous presidents. Why does this happen? I'm not trying to insinuate that this is their fault. In some sense, it's not their fault. In some sense, these individuals who are presidents of this country are just, they are obeying instructions that are given to them by financial analysts and consultants who tell them what to do. The Federal Reserve. Here is what Donald Trump has done in 3.5 years. And when I was looking at this section of debt, basically less than $4 trillion, I was looking at that a couple of months ago, and I was wondering how the hell will Trump's total national debt become the double of Obama? Because that's what I expected. There is a monetary crisis happening in the US. We've reached a period of exponential growth, and I thought by the time Trump is done, if he continues to be president a total of 8 years, I thought what will happen is he will double whatever Obama had done in this period, and then this will continue. But even then, since I expected that Trump will double the national debt, when you look at this, it's not on pace to double the Obama expenses. And to me, this was puzzling because, again, I don't think that Trump is better at saving money than Obama. I think there's something happening here. For example, the fact that Trump has not finished his term as president. So we have to wait until he finishes before we can actually draw the comparison. Still, my expectation, my guess, is that this number would be twice as much as what Obama did. And I couldn't see how. How the hell is that going to happen? I couldn't see how until the coronavirus struck the United States of America. And now I can see it. So we're going to be looking at that. How is it that these less than $4 trillion might grow way beyond anything that happened in previous years? But now I want to just compare this diagram to the diagram that I showed you previously, meaning look at the slope of this curve and the rate of growth compared to this one. This is the kind of government, the kind of image the US government is going to give you. We have this smooth growth, and then somewhat accelerated growth that, you know, seems palatable. I mean, why not? Why can't we just let the debt grow a little bit? How does this one happen? I'm going to show you how we can take the image that I've constructed here, this is my own image, and convert it into the image that you guys saw a moment ago. Meaning, let me see, there it is. Meaning, what can we actually do to this image to get the other one? And what's gonna happen is, I can just take this image from the top right here and I can compress it. And by compress it to fit a horizontal area, I can make it look much smaller than it is. And we're going to do something like that soon. But first, notice again that these are billions of dollars. So basically 25 here means $25 trillion. 5 means $5 trillion. And the problem is human beings are incapable of visualizing a trillion. A trillion is 1,000 times larger than a billion, and without any examples, the human mind simply cannot, we cannot even begin to imagine what this means. But still, there's an impressive slope of a curve here. All right, so we go now to a government image. This is a government image showing you the growth of money. How much money exists in the United States. So what you could write in your notes is that I'm now showing you an image of something known as the adjusted monetary base. The adjusted monetary base. That's the name given to the sum of all money that has ever been created by the Federal Reserve. And by money, I mean all the dollars, coins, currency that have somehow been created by the Federal Reserve or the Bureau of Engraving or the Mint or the Treasury, all the money that has been created at least since 1913 and deposited in Fed banks or commercial banks, or maybe it's under your bed. Every coin under your bed is represented by this curve. This does not mean that I'm showing you all the money that exists, all the dollars that exist in the US. That it doesn't mean that. What it means is this is all the money that exists that was created principally, almost entirely by the Federal Reserve. So now let me show you that on this website here. So here you have, if you want to find this image, you would just write adjusted monetary base on Google and you're going to get this page. They say discontinued because they have a nasty habit of changing diagrams every so often so that some things cannot be compared to the past. But let's play with it a little bit. Here we are in 1984, where all the money that had ever been created by the Federal Reserve was around $189 billion. That's it, 189 billions. And grows gradually over the decades. And here we see this surprising crisis where suddenly a lot of money is abruptly created in 1999, and then some of it vanishes by the year 2000. How can money vanish? Suppose that I'm the Federal Reserve and I want money to vanish. All I have to do is tell banks that I'm selling government bonds. The Federal Reserve creates money and gives it to the government in exchange for bonds. So now the Federal Reserve has a lot of bonds, government bonds. If the Federal Reserve wants to remove money from the economy, all it has to do is tell the bankers, hey, I want to get rid of some of these bonds. I want to buy them from you. So the moment the Fed gives those bonds in exchange for money, that money is taken out of circulation. So while we used to be up here, then we go back down because the money has been removed. I remind you guys, you're welcome to everyone write comments as I'm speaking, and I'll get to them in a moment. I don't have the the comment screen on, but I'll find a way to pull it up soon. Anyhow, there was a crisis involving NASDAQ, involving computers, involving Silicon Valley, and the stocks that used to be very high went down in value and people lost a lot of money. And anyhow, these things happen periodically, whether it's there was a savings and loan crisis, then there's the dot-com bubble. These things burst once in a while. We get to the housing bubble in 2007 and 2008. Hundreds of thousands, millions of houses and condos have been sold to people who don't have enough money, credit, or income to actually pay for the property they bought. What do they want to do with it? Well, if they can't live in it, they're willing to rent it. But eventually, there's so many houses that there are not enough renters. People have to start getting rid of some of the properties they have, because they can't find a renter and they can't pay it. And since they can't pay it, the mortgage money that the banks were published is just not available. It's just not there. The banks are not getting the money that was promised to them. So all these financial products that were supposed to be giving revenues to Citibank and Bank of America and Goldman Sachs are suddenly not giving us the revenue that we wanted. Investment banks like Lehman Brothers and Bear Stearns are going broke. Insurance companies like AIG cannot pay the debts, that is the credit default swaps, the insurance that these banks had bought in order to get rich off of the collapse of the housing market. So the Federal Reserve decides in 2008 to give billions of dollars to the banks so that they can cover their bets and they can continue making money and making loans. So now you're going to see what happens. Notice the diagram. What I'm trying to show you here is, here we are at, they were at around $870 billion by the fall of 2008, around 870 billion. And suddenly we get this huge rise. In other words, before this rise, notice this axis of debt. I mean, it's debt, it's dollars. 900 billions, less than 900 billion had been created by 2008. Less than 900 billion. Now, it's going to go up. It's going to go straight up. The amount of money created suddenly, it's going to go straight up, so far up that it goes out of the computer and out of your screen. Since it doesn't fit, the only way for them to make it fit is to change the scale. So here we go. What used to be 900 up here is now way down here. And here we see 2000, that is $2 trillion. And we keep moving this through the enormous creation of debt and money all the way until almost 2020. So what I'm trying to say is, you can see here the number, it says Wednesday, August 27, 2008. The value of the adjusted monetary base, all the money that had ever been created, is $877 billion. There's that number right there, 877. And now as I move this up, it goes to 1.7 trillion, 1.8 trillion, 2 trillion, 2 trillion, and then 3 trillion, way past 3 trillion, all the way up to, it's going to be about 4 trillion, 167 billion, around up, way up there. All of that money was created and given to the banks in a period of around 6 years. But what I'm trying to get at is this diagram is deceptive. This diagram doesn't quite tell you what's actually happening because we changed the scale. We used to have a 900 right here on the left. Now we've got a 4,400. So what I wanted to do is I wanted to create a diagram that would show you the actual growth in the amount of money. And here it is. Here is the Federal Reserve diagram with the comfortable light blue coloring to make you feel happy and rosy about life. And here's my diagram where the scale has not been adjusted. And we can see how initially a growth of, let's see, here we go, from the 19 teens all the way until 2008, a growth of up to $870 billion, then grows all the way to become this wall of cash. I see Kelly laughing. Maybe I have to unmute you. Kelly, you have been unmuted. Were you laughing? Are you laughing at this? But I thought you were laughing at this pile of money that was created, this wall of cash, unprecedented in the history of the United States of America, was created so that the banks would not lose their bets, so that they could continue getting rich. And here it is. So I would say this is the real adjusted monetary base. Here you have a diagram of how the United States has created money before 2008 and after 2008. So when Congress approved this package to help everyone from, I don't know, airlines and cruise ships and victims of the coronavirus and hospitals and businesses, what they've approved is an extension that goes further up on this diagram. Let's move on. How do we go from this chart, which I've drawn, which is the adjusted monetary base, to the chart that I illustrated a moment ago, which is, say, this one? This is a diagram about the public debt, and you can see this somewhat less horrifying curve. So what we can do, if you want to misrepresent things, let's take this diagram of the adjusted monetary base, grab it, and crush it vertically. Let's crush it. You can keep crushing it. We're trying to make this whole big thing disappear. So I crushed it. That still wasn't enough. We still see something weird here. So now I can say, well, let's edit this figure and let's cut some of it. View my ribbon. I'm going to cut some of it. Crop. I go to crop. I go here. I cut all of those years out. Now there's my image. And now that I've got this image, I'm going to expand it horizontally. There we go. And I'm going to compress it some more. And there we have a comfortable looking little wave of cash. See, so this is the weird thing about diagrams. If I just change the scale and change the length of decades that can be shown, I can get this, you know, rather cute looking cloud of money. Hey, there was a horizon of money and now there's a cloud of money and everything's fine. But in fact, what I've done is I've distorted the reality, which was quite clear from the full diagram, which is an unprecedented wall of cash was created in just 6 years to bail out the banks so that they could keep on making money. So write down these three words. You should already have adjusted monetary base. Write these two. I mean, these words also. Bubble, correction, recession. A bubble is a euphemism for a class of assets that is overpriced. For example, real estate. There is too much real estate being sold at prices that are too high, and at some point the prices will crash. We call that a bubble. It can happen with stocks, it can happen with bonds, it can happen with anything. But like so many other terms in finance, it's a euphemism. It makes something horrifying. It's horrifying. You bought a house, you think it's worth $600,000, but it's really worth $300,000, and you agreed to pay $1 million. It's horrifying. It's a kind of theft. It's horrifying. People become homeless. So this horrifying thing becomes known as a bubble. At some point, the bubble bursts. The bubble bursts. Let's just see. When the bubble bursts, what happens is, for example, the real estate, maybe the price of your house goes down to what it really should have been in the first place, $300,000. You bought a $600,000 mortgage. You're going to pay $1 million for your house over a period of, say, I don't know, 20 or 30 years. The bubble bursts, your house is now worth half as much, maybe less. Now, how do we describe that? Well, people in finance sometimes refer to these changes in the market as a correction. Oh, well, there were some assets, some stocks that were overpriced. They've gone down in price now. They call that a correction. Notice how again, it's a euphemism. It makes you feel good. Hey, guys, we were due for a correction. It's like, hey, good, this is good. We were due for a correction. The price has gone down to what it should have been. Yeah, we were getting ahead of ourselves. And now you've got millions of people homeless, millions of people broke. Some banks collapse. Some people become criminals because they do either financial theft or actual theft. And then in order to describe that process, we call it a recession. It's almost like, well, there was a tide coming in and then the tide went away and we're in a recession now, meaning people are not spending as much, people are not buying as much. So the diagram here of the adjusted monetary base includes these vertical gray lines. Each of these lines means a recession, each of these gray periods. It's a period in time. For example, here in the 1930s, there's a recession. And what is the recession? A recession is a euphemism for the Great Depression, meaning 25% of the people in the United States were unemployed, millions of people, soup lines, homelessness, banks that went out of business, et cetera, et cetera. So we give it the soothing name, a recession, and we color it in gray, and then we move on. A moment ago, I spoke to you about the adjusted monetary base. It's the Fed that gives money to the government. The Fed gives money to the government. What does the Fed get in return? The Fed gets assets. Some of those assets are bonds. Some of them are other things. One of the things that the Federal Reserve got in from 2008 until 2010 were mortgages, essentially mortgage-backed securities. The banks created products wrapping up thousands of mortgages into bundles. The bundles of mortgages were called collateralized debt obligations. These bundles of mortgages were sold to banks, such as investment banks, to sell them to pension funds and other investors so that they could get a trickle of cash or a steady cash flow. That's an asset. When you have something that gives you money, that's an asset. So the Federal Reserve gives a lot of money to the banks. The Fed gets mortgages or bonds or other things in exchange, and it puts those bonds, mortgages, etc., on something it's called its balance sheet. And here you have a view of the balance sheet, meaning this diagram right here represents the assets of the Federal Reserve. So meaning in 2008, it was relatively stable around here, then it went up. and then it went up again, and it went up again, and it went up again. And then we reached this peak right here, where the Federal Reserve, for the first time ever, has more than $5 trillion worth of assets. This is as of March 2020. Federal Reserve needs to give money to the US. They create a lot of money, and in exchange for that money, they get a bunch of bonds, meaning IOUs from the government. The government will pay this back. As I've said in class, the Federal Reserve is just a set of private banks. They create the money, they lend it to the government, and then the government uses that money for public works or healthcare or whatever it is. Here's the actual diagram at the Fed. Let's see. So again, if we go way back before 2008, what we have is a period of relatively constant assets where the Federal Reserve does not seem like an entity that is making purchases. The Federal Reserve is just something that's there to serve as insurance for the banks and to help in setting interest rates and so forth, lending money to the government. At this point, the Federal Reserve starts to behave like a super bank that is in the business of repossessing, meaning where did the mortgage finally go? It went to the Federal Reserve. In other words, the steep growth of assets here, this huge growth of assets in the balance sheet of the Federal Reserve, it represents holdings that they obtained from the banks. They gave money to the banks, and the bank gave them, say, junk mortgages. Because of this, the Federal Reserve became the largest owner of real estate properties in the United States of America. So this entity that should be working to basically bail out banks in times of crises and to help the government manage itself in a thrifty way, instead becomes the owner of enormous, unprecedented classes of assets until we reach this interesting moment, March 23, 2020. And for the record, today is March 31, 2020. So this is happening right now. All right. Let me see here. So again, what I've tried to explain is that this diagram here is the counterpart of this diagram. The adjusted monetary base creates this pile of cash. Pile of cash is given to the government, but especially the private banks. And then in exchange, the Federal Reserve then has this balance sheet with these amount of holdings, such as government bonds. Let me just see for a moment what comments we have. Chat, I'm looking at the chat. Charles asked the following question: why would banks buy those government bonds? Also, isn't it a self-defeating system, since to pay the bonds, the government then has to give the Fed more bonds to pay that first bond off? All right, so first question: why would banks buy those government bonds? As I said in one of the classes earlier, part of the reason is because banks don't want money. Just like rich people don't want money. What we call money, you and me, is money for poor people. Meaning I give you $100, you put it under your bed, and every year it's worth less and less and less until it's worth nothing. Money is as we know it, is a vanishing currency. Inflation makes it go away, such that maybe 100 years ago, you could buy a lot of stuff with $1, and now you can't buy almost anything with $1. So banks don't want money. What they want is assets. Assets are revenue streams. For example, why have $1 million when you can have $1 million worth of bonds? So that's why they buy the bonds. They buy the bonds because they're exchanging cash or money, which is something that's just going to vanish with inflation, for something that develops in the opposite direction. Also, isn't it a self-defeating system? Since to pay the bonds, the government then has to give the Fed more bonds to pay the first bond off. Yes, it's a self-defeating system, Charles. In order to pay the Fed, the government will have to create new government debt to then pay. So basically, the government can never get out of this. So what I was trying to illustrate originally when I talked about the national debt is, in a way, it was not caused by Obama. It was not caused by Clinton or by Bush or by Trump. This is an aspect of our monetary system which is built on debt. Let me just follow up on that thought. What I'm trying to say is the national debt never goes down. It doesn't go down. It's not going to go down. So whenever politicians complain about the national debt and how they want to change it, it's something that they do for the public. They want to make us feel good because they know that to us debt is a problem, and they claim that they're going to get everything in order. They can't. Not without getting rid of the Federal Reserve. Basically, they could get it in order by just sending one sheet of paper to the Federal Reserve written by Congress saying, we are not going to pay you any of the money we owe you. And with this letter, we hereby eliminate your right to exist. If they did that, the money vanishes. But without that, the debt will be there forever. Christina asked us, what is the takeaway from corrections? The corrections is the way that financial analysts try to make sense of why the market goes down. Sometimes the stock market goes down, as it did 2 weeks ago. And if it goes down a reasonable amount, and people say, oh, that was a correction. The market is still healthy. It was trying to clean out some of the bad investments, but it's gonna keep growing now. Like this is just, it's just a little thing. But what I was trying to argue is that it's a euphemism. It's a way to keep people's confidence in the market, even though the market's going down. So the market's going down, that is, people's money is disappearing. People's investments are losing their value. We don't want to say that. We don't want to say the Dow Jones lost 33% of its value in a period of 5 weeks from February to March in 2020. We don't want to say that sentence. So instead, what people say is, this seems to be a correction. It'll probably go back up tomorrow, etc. Isabella asked us, is the massive spike in the Fed assets in March 2020 specifically due to the stimulus bill passed by Congress? The answer is yes. This is part of the money. It could be that money in particular is not, I have to look at the exact dates. I bet you it's not because of the stimulus bill, but because of money given directly to the banks once the stock market started collapsing. In other words, when Henry Hank Paulson is the Secretary of the Treasury in 2008, he goes to Congress and to President Bush, and he tells them, I need you to give me an unusual power, which is I need you to give me the power to create, I think it's $750 billion, to borrow this amount of money from the Fed. I need you to give me that power. And if you give me that power, I'm not going to use it and I'm not going to need it. But I need you to give me that power. If you give me that power, the markets will regain confidence. if we judge people by the results of their actions, not by what they say, then we would say Hank Paulson is a liar. He said he would not need to use it, and he used it instantly. He used it instantly to create $350 billion to give to the banks, and then $350 billion to give to the banks. So he used it instantly. And that moment, 2008, is the moment when Congress gave the Treasury and the Fed the right to create unprecedented sums of money to use them without ever having to ask Congress permission again. So my bet is that the spike that we see at the past the 5 trillion mark, I say bet because I haven't checked this in detail recently, is not the congressional stimulus. That's but something slightly earlier, just a few days earlier, is just money given to the banks. All right, moving on. And I am reading your comments. You're free to write more comments, everyone. Where have we seen this before, this kind of rate of growth? If we just forget these stupid words, adjusted and monetary base, just forget that. And we just ask ourselves, what is this? What this is money. This is money. This is a chart about the growth of money. Where have we seen a growth of money similar to this? Germany, Venezuela, Zimbabwe, and countless many countries that have made the mistake of printing too much money too quickly and therefore creating hyperinflation. Kelly has a question. On page 364 of the reading, it talks about the Fed levitating financial markets so that household asset values would keep rising parallel to the growth of household debt. What does that mean exactly? What it means is the real estate market crashed in 2007 and 2008. The price of properties was collapsing. If the price of properties kept collapsing, then real estate people and the banking people and insurance people were all going to lose money because, for example, you could no longer get $1 million for that house. You're only going to get 300,000. So when the Fed buys the bad mortgages from the banks, when the Fed buys the mortgages that have stopped paying, then those mortgages are essentially, that purchase helps the banks keep doing business as usual. It levitates the financial markets because it creates a buyer where a buyer didn't exist. In other words, I've got something known as a junk mortgage. The mortgage is a promise of a steady revenue year after year in certain amounts, adding up to $1 million. The mortgage ends up being junk. It's a lie. The customer doesn't have a job. The customer doesn't have renters. The customer will never, ever give you the $1 million. So this product that we call a mortgage is just a junk mortgage. It's a bad contract. You're never going to get your money. Well, if that mortgage is bad and hundreds and thousands of mortgages are bad, then the market, the housing market is collapsing. The Fed sweeps in. They buy these properties, and by buying the properties, those properties do not necessarily go back into the market, and that way the price of real estate doesn't go down. So that's what the book meant. We're talking about the book The Great Deformation by former budget director of Ronald Reagan, David Stockman. Household asset values would keep rising parallel to the growth of household debt. Household debt had grown immensely, and it was going to continue growing. Everybody has a ton of debt, whether it's student loans or car loans or home loans, etc. So healthcare loans. So in order to keep the value of homes going up, The Fed sweeps in, they buy these properties, and it looks like everything's fine. So going back here, we have hyperinflation in Germany. And the period is, we're looking from 1922 until 1923. So we're looking at a period of, I don't know, about a year, 2 years. How come this happened in Germany? Meaning suddenly people were using paper bills to wallpaper their house, construction toys for children, and to sweep off of the street like total trash. But that hasn't happened in the US. The US dollar has not collapsed. Why is that? Why did this not happen when all that money was created? And the answer is that most of this money that was given to the commercial banks, for example, especially to Citibank, trillions of dollars given to the banks, it did not go towards buying things. Meaning you give it to a bank with no conditions, no strings attached, no questions asked, no guilt involved, no accusations, no criminal investigation. You tell Citibank, I'm going to give you $2 trillion. Here, take it. You can do anything with it. You can lend it out. You can hold it. You can pay it back. You can buy government bonds with it. I'm going to give you $1 trillion, $2 trillion. You can use it to buy bonds from me, and then I'll give you interest on that money that I gave you for free. No condition, no strings attached. If Citibank went out and bought houses, Citibank said, we want to use this money to buy every single house in the state of Texas, all of them. Every single house they could have bought, every single house that was for sale in the state of Texas. If they do that, then the price of houses goes up because there are no more houses available. But Citibank doesn't want to do that because houses lose their value. Every day, water gets into the house, wood starts to rot, critters get in, concrete cracks. So why would a bank want a house? A house is just a way to throw away your money. A bank knows that a house is a way to throw away your money. Bank doesn't want a house. A bank wants a mortgage. A mortgage is a gift that keeps on giving. Because while you have the house and your house is falling apart and you're paying for everything from property taxes to repairs, the bank is just getting a steady trickle of cash. That's the mortgage. Reed asked the question, does a bubble bursting have only to do with the demand falling due to rising prices? Or would running out of the product also cause a bubble to burst? The main reason a bubble bursts is not, is because demand falls. People stop buying it. It's like a pyramid scheme. It's like a Ponzi scheme. At some point, you don't have enough. You don't have enough buyers. But it doesn't have to be that you don't get more buyers because the prices kept rising. The price can remain exactly the same. I can create a business selling cookies and you all can be my employees and sell cookies and hire people to sell cookies and buy cookies, and eventually we just run out of people. Even if we keep the price at the same level, we can run out of customers. If we run out of customers, that's it. The bubble will burst. We're not getting any more revenue out of that. Would running out of the product cause a bubble to burst? No, running out of the product would not cause a bubble to burst generally, because if we sort of, for example, run out of houses to sell, then the bubble can well keep on growing because now people still need houses. So the price of a house can keep going down. Let me show you a couple more diagrams and then we'll go to discussion. So what I'm trying to say is this crisis that we see in Germany in 1923 has not happened in the US, even though US has similarly created enormous amounts of money. Why not? And the answer is because this money that you see here is not chasing real goods. For the most part, it's not chasing property. It's not chasing cars. It's not trying to buy supermarkets. It's not trying to buy gold or electrical wiring or toilet paper or anything. This money is trying to buy stocks. At some point, however, when stocks stop being profitable, when the stock market collapses, then people say, bankers say, you know what? I don't want to buy stocks. Stocks is the way to lose money. I don't want to buy stocks. So what do they want to buy then? Things like property, things like gold. When they do, then we get the hyperinflation. So one needs some sort of a tragic crisis event to trigger this. These events that don't come by except very rarely. These tragic events are known as a black swan. Black swan is a crisis, comes out of nowhere and wipes out a lot of money. And here is our black swan crisis happening right now. Job losses soar. US virus cases top world, more coronavirus in the US than in the other countries. New York Times. And what's most dramatic about this cover is this graphic down here. This is the number of jobless claims, that is people who want unemployment. These are jobless claims per year. And we suddenly see that in 2020, in March 2020, we have this enormous 3.3 million jobless claims in a span of 1 week. The largest growth of jobless claims in the history of the United States. Why? Because they told people to stay at home. And that's it. You're anything from a worker at South by Southwest to a waiter in a restaurant, a server, and suddenly you're out of your job. Financial crisis is starting. Dow Jones lost an enormous amount of money, as I was saying, and we have here the news. Dow plunges 10%, the biggest one-day percent drop since 1987. So this is how I posted it on my Facebook. Here's how investments suddenly vanish. February 2020, the Dow Jones was at 29,551. The Dow Jones was here at pretty much the all-time high in its long history. And 5 weeks later, it went down to 19,000 points. That is, in just 1 month, the Dow Jones sector of the stock market lost 33% of the value. 33% of people's wealth vanished. You'll be glad to know it's gone back up slightly. Today, maybe we are around 22 or around 22,000. That's known as the dead cat bounce. You have a cat on a fence and the cat falls down from a 30-foot fence and hits the ground, as in a stock market crash. We can ask ourselves, is the cat gonna get back up? And the answer is, yeah, it's going to bounce. So it bounces, but it's gonna go back down. So, if I were you, don't put your money in the stock market right now. This is the wrong time. And here is news that came out just yesterday. Job losses. Job losses could total 47 million because of the fact that the economy has been stopped in response to the coronavirus. Unemployment rate may hit 32%. What was it 3 weeks ago, 4 weeks ago? The unemployment rate was maybe around 4%. 4%. If the unemployment rate gets to 32%, this is larger than the unemployment rate during the Great Depression in the United States, meaning back then it was 24.9% of the population, the working population, had no job in by late 1933. So this would be terribly worse. All right, let me now change to unmute everyone, and let's see if we can get a bit of discussion going. Let's see here. Stop share. Unmute all. You're all unmuted. Let me read Isabella's questions. How does the answer to Reed's question translate to something like bubble or college tuition prices? So the way a college bubble will burst will be eventually students who paid $60,000 in loans to get a bachelor's degree, they go to try to get a job, they don't get a job, and the word spreads. The word spreads. You get your education at that university, you pay your 60,000 loans, you're not going to get a job. So people stop. They stop enrolling. As they stop enrolling, then universities start shutting down. And they do. Universities shut down all the time. Small universities, you can Google it. They come into existence. Hey, we can make a lot of money making a university. They come into existence. They hire a bunch of professors. They get a bunch of students. The students discover that their degree is worthless, and then the university shuts down. That happens. In the past 10 years in the US, that has happened, and it will continue to happen. So the bubble will burst when people realize that the degrees that they have bought are not going to get them the money that they need in order to pay the loans, and then it collapses. Question from Charlie Boy. Do you consider this a crisis due to the overvaluation of these index funds? The index funds, the stocks were terribly overvalued. It's unbelievable, the overvaluation. Real estate is super overvalued. Or is it a correction projection of future earnings? Yeah, the stocks are horribly overvalued. Stocks are overvalued, meaning that the price of the stocks of the company actually decouple from the real entity, and there's just a bidding war. People want this, so they trade, and this thing goes up and it goes up and it goes up with no correlation to whatever's happening down here. Remember, in many cases, the company sold the stocks. The company is now not benefiting from these stocks. The stocks are a liability because the company might be doing things like paying dividends, but are the companies overvalued? I don't know. I mean, you'd have to tell me a specific company, but I'm not a financial analyst, so I can't really be appraising companies. All I can say is when you look at the growth of the stock market, that growth is far larger than the actual growth, the physical growth of the companies involved in many cases. Why are they growing? Well, there's a lot of money sloshing around, trillions of dollars, where banks are, banks can buy their own stocks, companies can sell their own bonds and their own stocks and buy their own stocks to raise the stock prices. And when the stock price goes up, then they sell it all to get cash. They can do all kinds of things to manipulate the stock value, irrespective of the fact that the company is doing a steady job down here.
Okay, there we go. Sorry. So you said earlier in class that like right now is not a good time to like buy stocks. Like when do you consider a good time? When is the economy ever like really good? If there's always debt.
My impression is that the stock market has been due for a crash or a correction for a long time. Growth of these things, sometimes a stock market can be a certain value, and then it suddenly has this immense growth, then it crashes, then it has a relatively stable value, and eventually it starts growing. For example, after the Great Depression, 1929, the stock market crashed, and for example, the Dow Jones, these things took about 24 years to go back up to the price that they used to be. 24 years. So if if it was up here and it crashes and you buy before it goes all the way down, it's here and you buy here, it can keep going down, and now you lost money. And for 24 years, you have less money than you had. If instead you wait until it goes down and it stays down for say 2 years, it stays down, then that's considered a bottom. And eventually from there, it tends to go up, which is what we saw in 2008. In 2008, the stock market was up here. And for example, the index fund known as the S&P 500 was at, I don't know, maybe 1,300, maybe 1,500. And then it went all the way down to 666. Coincidentally, a number that has a weird meaning in the Bible. So it goes from, say, 1,400 until 666. And then it stayed down here a couple years, say between 700 and 900, and then it starts going up again. That's quite different than what we saw 2 weeks ago until this week, which is that for example, the stock market goes down and then it goes instantly up and then it goes down and it does this rattling thing. The unstable thing that it's doing right now, it's very unstable. Anybody have thoughts about reading The Great Deformation by Stockman again?
Can you explain a little bit more about Keynes' casino? Like, I'm a little confused with what that is.
Sure. So John Maynard Keynes, economist, does not trust that financial planners and investment bankers are going to do the best thing for the country. They're just trading to try to make money. Their goal is just to make money. So if their goal is just to make money, how is that going to make healthcare better? How is that going to make industry better? So because he thinks that, he thinks therefore that the government should intervene every once in a while to help, to kind of do something. So when the Federal Reserve steps in and they decide we're going to give billions of dollars to Wall Street in 2008 and 2009, when they do that, that's Keynesian economics. That's it. Because you had the crisis. The crisis was created by these casino gamblers. That is, they're all betting. I bet the house of your property will go up. I bet the house of your property will go down. I bet you will get rich on your bet. I bet you will go broke on your bet. I bet they start making all these bets. That's the casino. It's going to collapse at some point. These things can't work. So the idea is when it collapses, then it's okay for the government to step in and give them money and do certain things to fix it. That's Keynesianism. The government intervenes to keep the financial markets going. It's shorter. It's not socialism, because maybe in a socialist economy, the whole thing would be controlled. This is an occasional intervention that is supposed to make a difference. So you have the technology sector can collapse and then you lose your money. The housing sector can collapse and you lose your money. The banking sector can collapse, as it did by 2010, and you lose your money. So investors are always trying to find, where can I put my money and not lose it? And what investors want to do is they want to get out before it collapses. They know it's going to collapse. If something is growing like this, they know it cannot keep growing forever, because you cannot keep creating more and more people forever that will be buying that product. So they know that they're going to collapse. People like Jeff Bezos, people like Warren Buffett, they're trying to get their money out when they can. So they get it out. But if we're normal people, what financial planners tell you is don't get your money out of the stock market. This is just a correction. Just keep your money in the stock market. It's all going to be fine. This is a long-term investment. So this is the way they kind of lie to us, which is they don't tell us the obvious thing, which is buy low, sell high. Once it's high, you sell it. And then it crashes. Now you buy something else low and you sell it when it's high. They don't tell us that.
Okay, thank you.
All right.
Confused on the Krugman reading. He said that like a lot of economists didn't price in like a lot of like financial crises that have happened and like risks that have happened, but like wouldn't it be like their best interest to price those into like their models?
Say that again. Wouldn't it be in your best interest to what?
These economists or like bankers to price like recessions and like a downturn in the market in their models rather than like ignoring it.
Yeah, there's something strange about economics, which is what part of what led me to teach this course. To me, it's pseudoscientific. They don't want to look at the economy as something that malfunctions often. Instead, they want to look at it. Their models presuppose that the economy is this thing that works wonderfully. So what he calls the neoclassical group, what he calls the Chicago group, the same thing, is a group of economists that say, look, government should keep its hands off the economy because we're in a capitalist system, and capitalism and the economy will take care of itself. So notice how their model presupposes that if there's a crisis, it's going to clean itself. It's going to be fine. It's going to be fine. That's one side. Another side is these people who follow John Maynard Keynes, and they say, no. We're going to leave the market alone most of the time, but every now and then the government has to step in. John Maynard Keynes is writing right after the Great Depression, during the Great Depression. So he's responding, saying, look, if the government had just created money suddenly and given it, just flooded into the system, there would not be so much unemployment. Because the problem in the Great Depression is there's not enough money. So on the one hand, you've got this guy, you've got the neoclassical people. They say it works, let it work. On the other hand, you've got Keynes. Keynes says it works, let it work. But every so often, maybe every 10 or 20 years, the Federal Reserve and the government have to get in to fix it because the casino is dangerous. So they have to get in to fix it. Both of those are pretty optimistic. So for example, you get a guy like Bernanke, chair of the Federal Reserve, or a guy like Greenspan, and they share the same idea, which is basically this Keynesian thing. Hands off, the market is fine, and if any problem happens, we're gonna give a lot of money to the banks, and then it's all gonna be fine. But when they did that in 2008 and 2009, they found that it was not all fine. Banking institutions still collapsed. A bunch of people lost their jobs. A bunch of people lost their retirements. They lost their houses. So suddenly they thought, oh my gosh, what is this? But I don't know. I mean, I think it's psychotic. I think it's incredible that economics, it's almost like they're trying to follow the principles of thermodynamics. There's something about the system, the way they talk about financial systems, as if everything just kind of goes into these natural states of balance or something. They should do what you said, Amir. They should do what you said, which is create models that are based on these historical crises, a structure of financial crises. Understand how the crises happen and how they can be stopped. They should focus on that. Instead, Krugman says that economists look at those moments like little curiosities. Hey, isn't that weird that we had the dot-com crisis? Isn't that weird? It's a weird little thing. And then they say, isn't that weird that we had the savings and loan crisis? It's a weird little thing. Isn't that weird that we had the financial bubble of 2008? Isn't that weird? Hey, isn't it weird that we had the coronavirus crisis? These things are happening all the time. Every 10 years, we have a major crisis. Banks go out of business. People lose their money, but they want to act like it doesn't exist. So it's almost like there's a historical blindness to an economy. In other words, they're focused on mathematical models. They're focused on mathematical models, not history. All right, guys, I'm gonna let you go. Thank you all for being here. I'm going to switch off. That way it's more fun than if you all switch me off one by one. Take care, and I'll see you on Thursday.
Bye. Thank you.
Thank you all. Be good.